Here we are, Wednesday morning, July 9th. Wednesday morning, July 9th. Good to see everybody. Hope you're hearing me well. Hope you're seeing me well. I did a sound check, or my voice and my movement should be synchronized this week. But boy, what a week. I had a whole plan for you this week, folks. I was going to do a really great comparison. I had Jesse from our planning team working on a financial planning comparison of collecting Social Security at 62, full retirement age, waiting until age 70, because I've been hearing these conversations from people about collecting early, and some otherwise very smart individuals saying, well, geez, I'm going to collect early for these reasons. And I want to back it up. I want to be able to show the potential pitfalls and benefits of these collection strategies. But then on July 4th, we got the one big, beautiful bill handed to us. And boy, it changes a lot. And it started a big discussion around taxation of Social Security. So I said, this is an important topic. Let's set that one aside for next week, and let's address this because, and I'll touch on this more at the half-hour mark when we get into our financial focus. But there's a lot of misinformation out there. Some of it coming from directly from the federal government, and other misinformation coming from experts, quote unquote experts in the field. So I dug in when I started receiving this information, and I went right to the expert, Heather Schreiber, our Social Security strategist, Heather Schreiber. And I have some information about it for you. So we're going to get to that about the half-hour mark. And before that, we're gonna go through our usual process. So we're going to talk about some updates from the Slott Group. Surprise, surprise! It includes updates about the one big beautiful bill and of course the Slott mailbag. And then we're going to talk about some investment thoughts and ideas and analyst reports and what happened last week and what we're looking for this week. But the big question, like I said, is does this one big beautiful bill reduce your Social Security or tax on your Social Security benefits? And we'll talk about that shortly. So remember the goals I have for you as listeners. And before I get into that, I want to thank you all. This channel and these broadcasts grow over and over. It seems like every month, every week, whatever it is, and even the podcast gets more popular. So I can't do that without you folks. And if you know somebody who would benefit by this, and you think they would appreciate and be able to grow from this information, share it with them. There's no cost. There's no cost to logging on. There's no cost to listening to the recordings. And I think we do a pretty good job of packaging this live broadcast up and maybe cleaning it up and getting it out to you within a reasonable amount of time, usually by the weekend. That's our goal. Here it is Wednesday. We'd like to get these things out to you by Saturday morning. So remember our goals. We want you to be inspired to make changes. We want you to open your mind to different ideas and different ways of thinking about planning and investing. We recognize that we do things differently. I love it. We had a series of onboarding of new clients over the past week or two or three, or we can't take everybody, so we take a limited amount of clients every month, and we have these onboarding meetings where we it's an opportunity for clients to meet the team, and we check in and where we are in our process and things that we may need. But it's a lot of fun. It's one of my favorite meetings. But I love it when I hear the feedback from people about just the different approach that we have and the total team approach. So that's really exciting because we really have it dialed in, I think, and people appreciate that. So I want you to open your mind about different ideas and ways of thinking about planning and investing, because you've got to do things differently. Don't just don't follow the crowd. The crowd's potentially going to feel some hurt in the future. So we want you to stay educated so you feel confident in the plan and strategies that you have in place, and we want you to stay updated so you can make adjustments and changes along the way, because boy, we're not afraid of shaking things up and looking at things differently and making changes if we need to in our process. So today we're going to go over our slot updates, including with the addition of a segment of Heather Schreiber's newsletter and report, and that everybody seems to like quite a bit. And then we're also going to talk about market updates and analyst reports. And then we're going to dig into that financial planning topic, which today is, does the new One Big Beautiful Bill eliminate or reduce the tax on my Social Security? All these sections are indexed. So if you're listening to the recording and you don't want to sit through this whole hour of webinar, you can find the chapters or indexes and jump to the section that you're here for. And if you are here live, you're just going to have to hang in there. Right after I'm done this recording or this broadcast today, I have a recording with one of our favorite estate planning attorneys and elder law attorneys, Brian Adler. So you all have heard Brian several times on this webinar and this podcast. But Brian and I are spending an hour together recording a part of our advanced class series, our advanced workshop class series. So this is a series of what I've done in the past is 3 different classes that build on the changing world of retirement planning. And there's some updates to TrustWorks and or trusts and things like that I'm going to talk about with Brian. So more advanced estate planning techniques for our advanced class series. So that should be coming up. So we're going to have that. I'm hoping by early August, we've got that bundled for you, those 3 classes, and you'll be able to watch them at any time with some interaction as well. So I'm looking forward to that. So look out for that advanced class series. Okay, let's jump into our Slott Report. So let me just make a quick correction here, just so this is a little easier to read. I'm going to drop it all down to one page so I can share it with you. And good morning, everybody. Good to see you. Thanks for saying hello. So I'm going to share my screen here and read along with you. So this is from this week's Slott Report. You can see this just came out this morning. So this is from our friend Andy Ives. And it is the One Big Beautiful Bill Act. That's what the A means. So OBA. It's like ABBA, OBA. No IRA changes, but more Roth conversions. Wednesday, July 9th, 2025. So hopefully Ed Slott and Company is your trusted go-to source for all things IRA and retirement plan related. Let's be clear about the One Big Beautiful Bill Act of 2025. Enacted on July 4th, there is no Secure 3.0 in this legislation. It does not contain any changes directly related to IRA or retirement plan rules. There is nothing in the law specifically about Roth accounts, nothing about Roth SEP IRAs, nothing about 529 to Roth conversions, Roth IRA contribution limits, or any of the Roth topics we typically write about. However, what the law does contain are several items that relate to our bailiwick. Most of it can be framed as more items to consider and more opportunities when it comes to Roth conversions. For example, the reduced federal individual income tax rates originally enacted in the 2017 Tax Cuts and Jobs Act are extended permanently until Congress decides to change them. So that's important because the language that we've been hearing is, oh, we're extending these tax rates, and this is great for us as planners. I think it's not great for the country economically and fiscally, but it's great for us as planners because we have more time to do significant Roth conversions. But when they say things like permanently, until Congress, like Andy says, until the next Congress decides to change the tax law. So Congress can do nothing today that binds a future Congress. So it's these tax brackets are not permanent. They are in place until changed again. Now, why is that important? Because I've heard people say, well, we don't need to do Roth conversions because now these tax rates are permanent. The taxes aren't going to go up. Well, that's not what's likely to happen. We're still looking at potential tax increases, probably at about 2030 to 2032. The risks are getting a little bit closer with some spending and increased spending and changes to Social Security tax and things like that. But it's definitely not permanent. So I want you to hear that loud and clear. So this expands I'm right here. This expands the opportunity to do Roth IRA conversions at low tax brackets for future years. So again, we've got still a short period of time, maybe 5 to 7 years to get this work done. For 2025, the standard deduction increases from $15,750. That's currently at $15,000 for individuals, and $31,500 from $30,000 currently for married filing joint taxpayers. There are annual inflation increases for subsequent years, and that's how it's been. So they included, we got an increase of the standard deduction already in the beginning of 2025, and then there is an additional increase in standard deduction for tax year 2025. And it will be adjusted for inflation, as it has been as long as I can remember. This will expand the opportunity to do Roth IRA conversions. There is a new $6,000 addition to the standard deduction for seniors age 65 and older for years 2025 through 2028. So tax years 2025 through 2028. This is per person, so a married couple could deduct up to $12,000 if each spouse is aged 65 or over. That's on top of the standard deduction. And Andy just said that. This is in addition to the regular standard deduction and the extra deduction for those age 65 or blind. This will expand the opportunity to do Roth IRA conversions. Note that the deduction phases out beginning with modified adjusted gross incomes of $75,000 for individuals and $150,000 for those married filing joint. It phases out completely at $175,000 and $250,000 respectively. For those who itemize, the state and local tax or SALT deduction is increased to $40,000, effective for 2025 through 2029. So pay attention here, because these things are, many of these things are limited in, legislatively limited in this bill to a relatively short period of time, with a 1% increase each year. In addition, some pass-through business owners can work around the $40,000 limitation and get unlimited SALT deductions. More deductions could expand the opportunity to do more Roth conversions, Andy says. Taxpayers taking the standard deduction will now be able to make a deductible charitable contribution up to $1,000 for individuals and $2,000 for those married filing joint. This could expand the opportunity to do more Roth IRA conversions. In the past, you had to itemize to take charitable contributions as a deduction. We're not talking about qualified charitable distributions. That's completely separate. Nothing has changed. This is a $1,000 allowance for charitable contributions for individuals and $2,000 for those married filing jointly if they don't itemize and they take the standard deduction. There are now tax deductions for tips and overtime. While there are caps and phase outs, this could expand the opportunity to do more Roth IRA conversions, Andy writes. The child tax credit is permanently increased to $2,200 per child effective in 2025. With annual inflation increases, income limits remain the same at $200,000 for individuals and $400,000 married filing jointly. Guess what? Andy writes, more deductions could expand the opportunity to do more Roth IRA conversions. So Andy writes, have I been repeating myself? If so, my apologies. Oh, and one more thing. Did you know that there are now more opportunities to do larger Roth conversions? So Andy is a very funny guy. I love spending time with him when we get together at these Slott events, and you can kind of see his humor from his writing. So thank you, Andy. So now we're going to go into the Slott mailbag. This is a short one. This is from Sarah Brenner. You all have met Sarah before as well. The first question, can an IRA beneficiary do a 60-day rollover? So let's first talk about what a 60-day rollover is. A 60-day rollover is when you take a distribution issued to you, not to your IRA account, but issued to you, so the check has your name on it. You deposit that check or hold it. You do whatever you want with it. The rule says you can redeposit that check into an IRA in your name within 60 days. Within 60 days, and it is not a taxable event. Now, there are a lot of other requirements around that, and the biggest one is you can only do that once every 365 days, so you've got to be careful with that. But that is what a 60-day rollover is. We're not talking about a direct rollover. We're talking about taking that check in your name yourself and redepositing it into an IRA within that 60 days. So back to the question, can an IRA beneficiary do a 60-day rollover? The answer, only a spouse beneficiary can do a 60-day rollover from an inherited IRA if the funds are moving into an IRA in her own name. If a non-spouse beneficiary takes a distribution from an inherited IRA, those funds cannot be rolled over. A non-spouse beneficiary can move funds from one inherited IRA to another, but this must be done by a direct transfer. So there's almost no reason to do a 60-day rollover. It almost always makes sense to do a direct transfer. So, just generally don't take the risk. But moving on, next question. I am age 57 and retiring this year. I know there is an exception to the 10% early Distribution penalty when someone separates from service in the year they reach age 55 or later. I also know this exception does not apply to IRAs. I understand that if I roll over some funds to the IRA, then I can't use the exception when taking a distribution from the IRA. However, if I leave other funds in my employer plan, can I still use the exception when withdrawing those other funds? The answer is yes. The age 55 exception would be available for those funds left in the plan, even though it would not be for the funds rolled to the IRA. However, you will need to check with the plan to see if they allow a partial distribution with the remainder of the funds staying in the plan. Some plans will not allow this. So that last sentence is really important. Well, all of it's important, but that last sentence is really important too, because, a lot of the rules allow things, but the plans can be more restrictive. So you have to remember that. So a really good example is, can you take a distribution of your 401k, even if you're still working, and roll it into an IRA? So the answer is yes. Generally, the rules, regulations, tax code allows it. But so you could be 59 and a half. You could still be working at your job, still making contributions, still receiving your matching contributions. And yeah, you could, the rules say that you could take the full amount that's available for distribution, roll it over to your IRA and do what you want with it. A lot of people use that allowance to start doing their Roth conversions. But so that's what the rules say. The plans can say, nope. You got to wait. You got to wait till you retire. You got to wait till you're 65. You can't do that. You can only take a portion. There's a lot of things that can limit that. So you've got to know. You've got to ask, and you have to know. So let's move right into Heather. Heather Schreiber's Social Security and Medicare topic today. It's about Social Security. So here's the question. Dear Heather, I am currently single and will turn age 62 in September and plan to file for Social Security benefits based on my ex-spouse's record. We were married for 28 years. We divorced 3 years ago. He is age 67, but I'm unsure whether he has filed for his benefits. I know he's still working and has a high income. My questions are: 1, how can I determine the amount I can collect under his record without having to ask him directly? 2, if he continues working after I begin receiving benefits, will my benefit increase if his benefit increases due to his additional earnings? And this is signed by Angela. So let's see what Heather says. Heather says, Dear Angela, you do not need to contact your ex-spouse to find out how much you could receive under his record. The maximum divorced spousal benefit is 50% of his primary insurance amount. That's PIA, which is the amount he would collect at his full retirement age, or his FRA. To determine your potential benefit, contact the SSA, Social Security Administration, and request an estimate of your divorced spousal benefit. The SSA requires your marriage certificate and divorce decree to confirm you meet the 10-year marriage requirement. Because your ex-spouse is over 62, you have been divorced and you have been divorced for at least 2 years. You are unmarried now. You are considered independently entitled, meaning you can claim based on his record, even if he has not filed for benefits. So that's different compared to if they were still married. If you qualify for a retirement benefit, SSA, Social Security Administration, will pay the higher of your retirement benefit or the divorced spousal benefit, not both combined. Additionally, let's scroll this up so you can follow. Additionally, if you file at age 62 as planned, your benefit will be permanently reduced for claiming before your full retirement age. Your benefit could increase if your ex-spouse's continued work results in higher earnings that replace lower earning years in his 35-year Social Security earnings history. Because your divorced spousal benefit is calculated as a percentage of his PIA, any increase to his PIA would also raise your benefit. So her question was, if he keeps working, will I get more? And this answers that. So any increase to his PIA would also raise your benefit. However, if his earnings do not improve his PIA, that is, he has already earned his highest 35 years, then your benefit would remain unchanged. Any adjustment based on his new earnings would typically appear in your benefit amount the year after his earnings are reported to SSA, again, the Social Security Administration. All right, I hope that information was helpful. Let's now talk about the markets. So, it was an interesting week last week. I'm just going to read the analyst report here. So we had a change in our investment committee, a really positive change. So we brought in a woman, a really bright individual who has a great great bit of experience. She's a chartered financial analyst. She's a certified financial planner. She's been at this for a long time, and she seems to be very good at what she does. So she's now, her name is Lydia, and if your clients, you received an introductory email about Lydia and the change to our process, which again is very, very good. I asked Lydia to put together the investment portion of our webinar for me every week, and she's been doing a very, very nice job. So I have to thank her for that. And let me read some of the information she put together. So the short holiday week ended on a high note last week. So July 4th, right? We saw the signing of the bill, and we were all closed. We had a little bit of a long weekend, so that was nice. But with all three major U.S. equity indices, so that's stock market indexes, closing the week higher, with the S&P 500 and NASDAQ composite hitting record highs. We had some reports last week. Non-farm payrolls rose by $147,000 in June, above the initial forecast of $110,000. The unemployment rate also fell to 4.1%, while economists had projected an increase of 4.3%. The strong results also spurred an increase in Treasury yields and reduced expectations for the Federal Reserve to cut interest rates soon, and unlikely in July as initially indicated. So what that's telling us, like I just said, we may not be seeing these rate cuts that were expected. The 10-year Treasury then ended the week at 4.35%. So these are bonds. The 10-year Treasury, when we say that, these are bonds that are issued by the U.S. government with a 10-year maturity. So if they're issued today, obviously they mature in 2035. The U.S. manufacturing sector contracted for the fourth consecutive month in June, according to the report from the Institute of Supply Management, or the ISM. However, the ISM Manufacturing Purchasing Managers Index, or the PMI, was at 49%, up from May's report, and just shy of the estimated 49.1. As a reminder, readings below 50 indicate slowing or contraction. The Dow Jones Industrial Average ended the week up 2.34% and is up 6.33% for the year. The S&P 500 gained 1.75%, bringing the year-to-date return to 7.49%. And the NASDAQ ended the week 1.63% up, resulting in a 7.07% return for the year so far. We saw a lot of growth so far this year in international stocks, but they were relatively flat last week. The MSCI EFA, or Europe, Asia, and the Far East Index, which measures the performance of developed international markets, gained just 0.07%. But like I said, it's had a strong year so far, being up nearly 20%, 19.98% year to date. U.S. dollar continued a downward trend. We're down over 10% on dollar values year to date. Gold continues to be strong, up 1.68% last week and up 26.58% year to date. And this is largely driven by gold's role as a safe haven amid geopolitical tensions and persistent inflation concerns, and everything that we're hearing day to day. So what do we have coming up this week? So the 90-day tariff pause was scheduled to end this week, but on Monday, President Trump announced that it has been extended until August 1st. So the markets responded with an initial sell-off, but then stabilized. Today, Wednesday, we receive wholesale inventories. They'll be announced, which is an early signal of inventory trends and supply chain health. And we also get the FOMC minutes. They're going to provide additional insight on rate paths, so where interest rates might be, inflation outlook, and timing of potential cuts. So one of the things that I like to do is, and I started, way back now in 2020 when we started doing these webinars, I would look for analyst reports that were, that might be helpful. So the larger firms, I'm talking about Goldman Sachs and BlackRock and Wells Fargo and some of the other ones, and I've shared these with you. And one of the things I look for is, that we've got these large companies and they have differing points of view about where they're putting their money, what they think the markets are going to do. And I was having a conversation with a person about this, and they said, if the big guys don't know, if they can't agree, how are we supposed to make investment decisions? So we'll talk about that a little bit, but So what I like is to have kind of competing ideas, right, or conflicting ideas. So let's first talk about positive outlook. So J.P. Morgan expects continued economic growth. They say no recession, sticky inflation, and rate cuts by year end. Wells Fargo is citing deregulation, strong earnings, resilient consumers, and U.S. emerging independence. Now, these all have positive market outlooks. Goldman Sachs Asset Management co-head sees tariff volatility but anticipates rate cuts if the data weakens later this year. He expects broader market rallies, including in European and small cap markets, so stocks. Also, Schroders upgraded its outlook for global corporate bonds to neutral from negative and maintains its positive view on global equities as it expects reduced risk of U.S. recession. So these are four major firms that are telling us that, hey, we expect things to be positive. Now let's talk about our bearish outlook. They expect things to not be so great. So Bank of America expects that strong labor markets may delay Fed cuts, but weakness could trigger a 0.75% cut in September. They expect the U.S. economy to muddle through with no cuts until a downturn. So they're not expecting any cuts until we see an economic downturn. Schwab described the market tone as slightly bearish from the upcoming week, citing overbought conditions and potential tariff-related shocks. BlackRock talked about uncertainty, remains underweight long duration treasuries, so maturities longer duration, and maintains caution around the Fed policy. So what do you do? What do you do when the big guys, right, the big men and women who make these decisions can't decide? Well, you've got to have your financial plan drive your investment decisions. So your financial plan should be the driver of when you're going to need your funds, how much you're going to need, and therefore how they should be invested. And then what works for us and our clients is the three pillars of investment management. So once you've got your plan figured out and the funds you're going to need and when you're going to need them, you rely on strong asset allocation, some portion of principal protection, and account segmentation. So if you don't know what I'm talking about, there are videos. We have a very good video. We're going to do another one coming up for the advanced class where I'm going to talk about this more in advanced investment techniques. So if you're interested in that, you can attend that advanced class for free. We're not charging anything for it. But these are these ways you overcome these concerns about, well, geez, if the Goldman Sachs and Wells Fargo can't agree, or we've got J.P. Morgan and this other company can't agree, and they've got all these resources, how am I supposed to make a decision? Well, you don't. You let your financial plan drive your investment decisions, and you structure it appropriately so you have that strong foundation of asset allocation, principal protection, and account segmentation. And it's not going to surprise anybody to hear me say, and you must review it on a regular basis, and that should be at least once a year. And what that means is that you should review your financial plan completely and thoroughly once a year. Somebody asked me how often we review our investment strategies. Well, we have an investment committee meeting, or we have two investment committee meetings every week, Tuesday and Friday mornings. So we take it very, very seriously because that is the fuel that drives the success of the plan. I'll get off my soapbox there, and we're going to jump into our financial focus. This is the financial focus portion of this webinar. So we've just talked about a lot. We spent a half an hour together talking about updates from the Slott Group that affect your IRAs, Roth IRAs, conversions, rollovers, and all of that. We had some updates from Heather Schreiber's Social Security report. We're going to talk more about Heather in this portion. And we had market updates. So if you want to, you can go back and look at that weekly webinar. If you're just here for the financial focus, dig in. We're going to talk about, does the new tax law eliminate or reduce your Social Security tax? So let's see what the answer is to that. So I'm going to share my whiteboard, and we're going to walk through this a little bit. So what happened here? Why is this such a big topic right now? Well, I shared with you in the beginning of this webinar that I had a completely different topic lined up and in mind that also had to do with Social Security, but it had to do with claiming strategies. But then on July 4th, last week, 2025, so I don't know when you're listening to this, if you're listening to the recording, but it is July 9th, 2025. So just last Friday, the One Big Beautiful Bill Act was signed into law. And one of the things that it changes is overall taxation for seniors. I'm going to say that. But what's the headlines are saying a reduction or elimination of tax for Social Security. Now, I read that with some skepticism, thinking, okay, well, let me look at this, and because it didn't seem to me to be a direct impact on tax for Social Security. And then I received an email from a quote unquote Social Security expert, not Heather, somebody else who calls himself a Social Security expert, and he kind of misunderstood or mischaracterized the effect of this bill. So I read it a couple times, and I reached out to Heather. So Heather's our Social Security strategist. She's one of the best in the nation, and I met Heather through my affiliation with the Slott Group several years ago, and she, I brought her on. It's been a few years now on a retainer basis to be part of our team, and she reviews Social Security claiming strategies for each one of our clients, and that's extremely helpful. But it's also helpful just to have her expertise on the team, because I had a lot of conversations with Heather over the past few days about this. And she said to me, thankfully, she said, because I'm going to refer to this newsletter, she said, hey, I'm typing up the newsletter right now about this because it's so important. There's so much misinformation out there. So, I've had these conversations with these experts and colleagues, so that I've been talking to colleagues about it too. And some colleagues are completely misunderstanding it. And advising their clients, hey, you don't have to pay tax on Social Security anymore. And some are pretty close, but their calculations are wrong. They're pretty close, but it's not quite there. But we've been having I've been having these conversations with experts and colleagues, and I wanted to help clear the air a little bit. So hopefully this does. So let's just go through the list here. So what is the new law? What is the new law? Well, there's a lot to the. It's huge. It's a huge law. So it's the. We're talking about the One Big Beautiful Bill Act, and it's enormous, and there's a lot of changes. But here in this section, we're talking about the potential effect on Social Security taxation. So what this does is it allows for an increased deductions for taxpayers age 65 or older. So age 65 or older. But this is only for tax years 2025 through 2028. And then it's also reduced based on your modified adjusted gross income. So I'm going to talk about that more in a moment. Well, let's just go into it. So I'm going to come over here. So this is an excerpt from Heather's newsletter that she does. And this just came out yesterday. So let's give Heather the credit she deserves. But she writes, beginning in 2025, seniors age 65 and older may deduct up to $6,000 or $12,000 for joint filers. This deduction is reduced by 6% of modified adjusted gross income, or MAGI, over $75,000 for single filers, or $150,000 for married filers. It phases out entirely to $150,000 or $250,000 respectively. It applies after adjusted gross income is calculated, is in addition to the standard deduction, and does not lower MAGI for purposes of calculating income-related monthly adjustment amount, or IRMA, surcharges for Medicare. So it's not going to affect that at all. But that's how it's written, right? So it's an additional $6,000 per person. So if you're a joint filer, age 65 or over, for a limited period of time, then it's 12,000, right? So 6,000 times 2, and this is on top of the standard deductions already that we have now. So that's a good thing. In truth, she writes, in truth, the statutory framework governing the taxation of Social Security remains unchanged. The new deduction is a temporary tax benefit, not a structural policy shift, because the Byrd rule prohibits, and we're going to talk about that a little bit more, prohibits changes to Social Security's benefit formula or trust fund financing in reconciliation legislation. The campaign era pledge to eliminate benefit taxation, she's talking about Social Security benefits, taxation could not be enacted via the One Big Beautiful Bill Act. So let me come over and go back to here. So what is not in the new law? So Heather just told us. So we know what is in the new law. right? Increased deduction for taxpayers age 65 or older, but only for a limited time for tax years 2025, 26, 27, and 28. And it's reduced based on modified adjusted gross income. So you can see that here. We just went through that. I'll hold that there for a second if you want to take a screenshot of it. What is not in the new law? Changes to the formula that determines tax on Social Security. That's called provisional income, or what we call PI. And why? Because, well, there's probably a lot of reasons why, but primarily because, like what Heather talked about, the Byrd rule. So that was from Senator Byrd, and the Byrd rule says that you can't make these significant budgetary changes to during reconciliation. Now, let me see. I think I have information on that. Let me see. I thought I posted it in here. So anyway, that's what the Byrd rule says. So the Byrd rule says that you can't make significant changes to Social Security and other budgetary things in the reconciliation. So reconciliation is if you don't have the 60 votes required in the Senate to pass a bill. Normally, you go through this reconciliation process, and it's limited, and that's why we see things like these restrictions on dates. Like this new deduction is for a limited period of time. Other things are a limited period of time. It's, the Tax Cuts and Jobs Act had a 10-year sunset at 12/31/2025 because that was via reconciliation. So if you can't get the support of at least 60 senators, then you've got to do it a little differently. And that this reconciliation is what is how we got the One Big Beautiful Bill Act. So let's talk about provisional income and what's not in the tax law. So these are the provisional income brackets. So provisional income is the income that Social Security tracks, or the IRS tracks, to determine how much of your Social Security benefit is taxable. So these brackets are pretty easy to remember. Let me get myself out of the way here so you can see the whole thing. There you go. All right. So these brackets are pretty easy to remember because they haven't changed since, I think it's 1983, but it's certainly the early 80s. So if you're, this is for a single filer up here. This is married filing joint. So if you're, let's just go with a married couple here. If you're under $32,000 in provisional income, so provisional income can easily be, the formula simply is modified adjusted gross income plus 50% of your Social Security benefit. Yeah, you got to add that back in. I know. And then plus tax-free interest on municipal bonds. So any tax-free, if you're just listening to the podcast, I'm air quoting, and you all can't see me anyway because I took myself off the screen. But I am air quoting tax-free municipal bonds because you have to add that interest back in for that inclusion of provisional income. So it's modified adjusted gross income plus 50% of your Social Security benefit plus tax-free interest. So if all that adds up to under $32,000, then you don't pay any tax on your Social Security. If it's between $32,000 and $44,000, up to 50% of your Social Security benefit is subject to tax. Above $44,000, up to 85% of your benefit is subject to tax. So that hasn't changed. That hasn't changed. Again, I think it's been 1983. Now, the problem with this is that more and more people are subject to tax on their Social Security because these thresholds were put into place decades ago, when I was still in high school, and incomes have increased. So what we should do is we should make, if we really want to affect change to Social Security taxation, then we should make changes and updates to the provisional income tables and allow for increases based on some cost of living adjustment. So let me see if I can bring myself back in here. So, but that didn't happen. That didn't happen with this act because, like I said, because they can't make changes to this portion of the code without having the full majority of the Senate. So we're back to that Byrd rule limitation. So that's what's changed. And that's what haven't changed. So now we're working with the same formula with Social Security. So did the One Big Beautiful Bill Act reduce the tax portion of your Social Security? The answer is no. Could it reduce or eliminate the tax you pay on your Social Security benefit? Well, maybe it could, and it's based on your age, your income, and it's for a limited time. So the reason I say that is if you qualify. So if you're, first of all, you have to be over 65. You have to be over 65 to have this apply to you. And it's only for tax years 2025, 26, 27, and 28. So it's only for a limited period of time. And you can't make too much money. So if your modified adjusted gross income falls over these thresholds, then you have a phase out or an elimination of this additional $6,000 for individuals, $12,000 for joint filers. So it might reduce your benefit. So I've got an example here, and the best example I found, simply, so I've been spending a lot of time on this. The best example I found was, believe it or not, on Instagram. So I had planned on writing out an example, and I wanted to get to, kind of a zero tax on Social Security example here for you. But I was going through yesterday, scrolling through different things, and I follow a lot of financial stuff on my social media, and there's a person called Money Cruncher that I see on or a post all the time, Money Cruncher on Instagram. So I want to give him credit because I just thought it was a great example. So let me run through it with you. So here's an example of where this does eliminate tax. It's really not just the elimination of Social Security tax. It's eliminating if you qualify for this additional deduction, you eliminate tax overall. Therefore, it may eliminate or reduce your Social Security tax. I hope you understand what I mean, but I hope this illustrates it. So let's do a married couple, both age 65. Their total income is $95,000. Now, I'll just tell you right off the bat, and we were having a meeting yesterday, and our CPA, Sasha, said this, it's not going to affect most of our clients because your income's higher, your modified adjusted gross income is higher. So your benefit of this additional amount for this limited period of time might be very, very small, if at all. But let's see a couple it may work out for, just so you understand how it works. So they've got $70,000 combined of Social Security benefit. This is very, very simple, but it works well, of Social Security benefit. The taxable portion of their Social Security benefit, based on their provisional income calculation that I just shared with you, is $19,600. So that's taxable. That's not the tax on the Social Security benefit. That's the taxable portion of their Social Security benefit. After you add up their income, take 1/2 of their Social Security benefit, and then any tax-free interest, otherwise tax-free interest, that gets added back in for provisional income. They have a pension or other income. It could be anything, other income. In this example, it was a pension, taxable income, we're going to call it, other taxable income. So then their total income here is $44,000. They're $600. And so that's their line 9, 10 on the 1040 income. And then their standard deduction, because they're both over 65, is $33,200. So this is the old way, right? This is the old way. Before July 4th. $33,200. That takes their taxable income. So you subtract this from this. That takes your taxable income to $11,400. Most people, now go back to the standard deduction for a second. This is their standard deduction. And this is prior to One Big Beautiful Bill Act. The standard deduction is if you don't itemize and your itemized deductions aren't over what the standard deduction would be, then you use a standard deduction. It's pretty simple, and most people that we see that are over 65, that's what they're doing. They're using their standard deduction. So then $11,400 is their taxable income, and that makes their tax then. We've got one based on this amount. You think about it. This amount flows into that graduated cylinder, right? So we start with, let's take me out here, 10, 12, 22, 24, 32, 35, and 37. So this is the amount. The taxable income is the amount that flows into here, and then they're taxed at whatever rate they land at, right? So their tax on that $11,400 is $1,140. So they're clearly landing in the 10% tax rate here. So now that's prior to OBBA, the One Big Beautiful Bill Act. I'm really interested to see how we're going to communicate this in the future. All right, so now if we add $12,000 to this standard deduction, this is pretty simple. Let's make this green. Let's make it a little easier. So we're gonna add $12,000. So this is now with OBB, One Big Beautiful Bill Act. So we add that $12,000 for anybody over 65 who qualifies, right? Their modified adjusted gross income is below the thresholds here. So this couple qualifies. Well, if their taxable income is $11,400, this $12,000 is going to wipe out that $11,400. So their tax is actually going to be zero. So here is an example of where someone could say, well, geez, before I was paying tax on my Social Security, but now I'm not. Well, in reality, it's the totality of it, right? It's the totality of their taxable income, whether it's from Social Security, whether it's from their income combined. It's this additional deduction below that line that is creating the reduced tax. It's not reducing anything with this provisional income, not changing anything with this provisional income. So there is not a direct correlation to anything in the One Big Beautiful Bill Act and reduction or elimination of Social Security tax. It all has to do with the increased amount that's available to some seniors who are over 65 for a limited period of time, who don't make what the government deems as too much money. So the federal government is saying that the White House Council of Economic Advisors, they're saying the enhanced deduction may increase the share of seniors paying no federal tax on Social Security benefits to as much as 88%. However, this benefit is limited in duration and reach. Again, this is from Heather's newsletter. Some younger retirees, particularly those 62 to 64, may be disappointed to discover that the deduction applies to them, and others may mistakenly assume that the change permanently alters how benefits are taxed. Neither of those things are true, right? So it doesn't apply to people 62, 63, 64, only those over 65, and it is not a permanent reduction in tax, nor is it a significant change or any change in how Social Security is taxed. Could it reduce your overall tax, therefore your overall taxable income by another $6,000 if you're single and over 65 and meet the income requirements, or $12,000 as a married filing joint couple if you're over 65 and meet those income requirements? Yes, it could for a limited period of time. So I hope that, geez, I know it's confusing. I hope that's helpful. I hope that brought some clarity to this confusing topic. Now, the reason it's so confusing is that, kind of the message that's being delivered about it, that it's a reduction of Social Security tax. And it is not a reduction of Social Security tax. It's technically a reduction of all income that's taxable because of the additional deduction for some seniors for a limited period of time. And could you just apply that to the Social Security portion of the tax? Sure. Or it could be part of your tax on your pension or part of your overall tax, however you look at it. So I hope it's beneficial to you. I hope this information was helpful. If you have any questions, you can reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com. If you have at least $1 million in retirement assets and you want to schedule time with me, you can also reach out to us at questions@attleborowealth.com. We will have a webinar next week, and I am looking forward to it. And I'm looking forward to seeing you all again. And I hope you all have a great week. Take care. Bye-bye.